Hello, welcome. Thank you for joining us. This is the fourth part of Saxe, Doernberger, and Vita's webinar series on hurricane insurance coverage. I'm very happy to have with me here today Greg Podolak and Holly Rice from our Southeast office. They're here to talk to you about today's topic, which is hurricane insurance considerations for coastal properties. Greg and Holly are members of our private client services practice group, and they are well versed in this area of insurance coverage with lots of valuable insight to share on the topic. Before we go any further, let me go ahead and introduce myself and have Greg and Holly introduce themselves. Greg, why don't we start with you?
Sure. So Greg Podolak, I am managing partner of the Southeast office. I work routinely with clients from a wide variety of backgrounds, both commercial and personal lines, dealing with all manner of insurance recovery concerns and considerations.
Thank you. And Holly, go ahead and introduce yourself, please.
My name is Holly Rice. I am an associate attorney with Saxe, Doernberger, and Vita. I represent commercial policyholders and also am part of our private client wealth practice group.
Thank you. And my name is Kelly Johnson. I, along with Greg and Holly, work in the Southeast office here at SDV. I'm a commercial litigator. I've been practicing about 13 years, and my focus has been exclusively on policyholder insurance coverage work since I joined SDV. I'm also the Senior Associate for the Natural Disaster Recovery Group here at SDV, which now more than ever has been a significant part of our nationwide policyholder insurance coverage practice. So without further ado, let's get started on today's presentation. Greg, can you start off by telling us a little bit about, from an insurance perspective, how coastal properties differ from inland properties?
Sure. And I think as a bit of an introduction to answering that question, and I think something that we're going to talk about thematically throughout our conversation today, it's important to understand when you think about insurance purchasing strategies, insurance recovery strategies, on some level, depending on the types of issues you're dealing with at any given time, it's always important to remember that underwriting and insuring risk is really all predicated on understanding the nature of that risk. And so I think I'm routinely talking with my clients about, taking some time to really think about what is the nature of the risk you're trying to insure, what's the concern that you have, and then at the end of the day, the insurance policy they're purchasing is on some level a commercial contract. And so what you're trying to do is understand how that commercial contract is written to match the definition of the risk that you understand that you're trying to insure. So when you ask the question, Kelly, why are coastal properties different from inland properties in this context? Part of what we're trying to do is get a better understanding, a better definition that we can take some ownership of what that risk is. And coastal properties, put simply, they have more exposure to potentially catastrophic elemental damage claims, and of a more unique variety. And as a result of that, you see the insurance markets tend to have a very complex understanding of the nature of the risk they're willing to take on. And different properties come with different features and different issues. And then the nature of what's on different properties can lead to more significant and more complex exposure. So, in South Florida, we're always talking about water issues, and that's a lot of what it boils down to. And the question becomes, if you're going to have exposure to potentially catastrophic loss related to the elements or how the elements affect water areas, be it coastal or even inland, intercoastal areas, you need to understand how that's going to interact with your property and the main concerns that you have that you're trying to insure there, because the insurance products that you're going to see are going to typically be written in a very nuanced way to account for a lot of those considerations.
Thank you, Greg. Now, Holly, from an underwriting perspective, can you tell us what qualifies as a hurricane typically in these scenarios?
One thing I just wanted to mention in talking about what qualifies as a hurricane is just to point out that, in going off of what Greg just said, being that coastal properties have greater risk, you can see that hurricanes can cost a lot of money and create devastating losses Hurricane Katrina hit over $125 billion in 2005. So what qualifies as a hurricane during underwriting actually is going to differ between states. So when you're looking at your particular policy, you want to know what triggers a hurricane in your state. Don't be afraid to ask questions of the insurance agent to understand exactly what the trigger is and what your policy says about that trigger. In Connecticut, for example, a hurricane trigger will occur when the National Weather Service declares a hurricane that records winds of 74 or more miles per hour. The trigger remains in effect until 24 hours after the last hurricane warning or until the hurricane is downgraded. In Florida, for example, it's a little different. Florida statute 624.4025 defines a hurricane as a storm system that the National Hurricane Center declares to be a hurricane. It includes the time period from the beginning of the time a hurricane watch or warning is issued until 72 hours after the termination of the last hurricane watch or warning issued for any part of Florida. Also, you have different definitions for hurricanes and windstorms, for example. In Florida, a windstorm it's going to be defined as wind, gusts, hail, rain, tornadoes, cyclones, things of that nature, caused by or resulting from a hurricane. So in Florida, for example, there are cases that say the courts have said tornadoes that form during a hurricane are actually considered hurricanes for purposes of insurance coverage. Other states do not necessarily require that the windstorm arise out of a hurricane. And courts tend to define windstorm as wind that is strong enough to disturb the insured property, either by wind itself or by projecting an object. Some states, like Maine and Kentucky, for example, have added a requirement that the wind must be strong enough to damage property that is in reasonable condition. So if the property is already in disrepair and the wind would not have damaged the property but for its disrepair, there may be a coverage issue there. You should also look at your property policy because windstorms are often something that gets excluded. So separate windstorm insurance may be something that becomes necessary.
Yeah, and I think that last point is really a good concrete takeaway for people to think about. And I would compartmentalize it a little bit further so that people kind of know when they should be thinking about it, especially as we're talking to clients in our private client services grouping. It's the earlier you can be thinking about these distinctions, going back to my comments from before, the better. And that's, that can go as early as when you're placing a program and talking to your insurance advisors about what should be in there and what the market yields and exactly how the product is written. The better understanding you have, the earlier, the more likely you are to be prepared to either have whatever negotiations may be available for a better product, or at least have a better understanding of how you can expect that policy to respond if and when an event actually does come along. And I think that is what I'll call more of the transactional mindset, how you think about the product you're purchasing in the first place, that it should also be thought about and can be thought about even when you are in a post-loss scenario and you're looking at a policy you've already purchased and that's the resource you have. Now, like I'm suggesting, ideally, you don't want to be getting familiar with the terms of your insurance policy the night before the hurricane hits, kind of like I was doing when Irma came through a few years ago. And I said, given what I do for a living, I should probably have a sense for how my insurance is going to respond. And then, of course, the next day it was the eye of the storm was hovering over my house. But even in a post-loss scenario, it's incredibly important to think critically about what's in your insurance policy contract and what the precise nature of your loss is. There are a lot of loss narratives that can easily be described one way, which doesn't align very well with coverage, but also just as easily be described another way. That could align with more coverage. So I think it's important to understand, even if you have water damage to the interior of a home, and you might initially suppose that that's something that's flood related, a type of issue that often has significant limitations in most commercial and even personal first party property policies. That doesn't always necessarily mean that the event you're experiencing matches that definition. It's going to depend on what the policy says that definition means, if it's defined. As Holly alluded to, it depends on what the courts say about that definition, because ultimately they're the final arbiter of how these insurance policy contracts get interpreted. And it's going to depend on the facts. And a lot of times the facts are not always conclusive about what's causing a particular loss. Yes, it may be water that is coming in and appears to be a flood, but what are the circumstances precipitating that water coming into the building? And it may very well be that those circumstances are actually what's causing the loss, not the water itself.
Well, speaking of flood, do homeowners or commercial property policies typically cover flood in these situations?
Well, actually, a homeowner's policy is typically going to have an exclusion for damages resulting from flood. So that said, we could talk about concurrent causation, and we actually have another webinar on that that discusses current causation, but it's at least worth mentioning that in some jurisdictions, the law, courts will provide coverage for property damage resulting from flood when another covered peril simultaneously causes the damage. That is not necessarily true of all jurisdictions, and that's not necessarily true of all policies, because policies will have anti-concurrent causation clauses, which could exclude that type of scenario. Nonetheless, a common flood exclusion will exclude water damage caused by flood, surface water, waves, tidal water, tsunami, or overflow of a body of water, storm surge, or spray from any of those, whether or not it's driven by wind, hurricane, or a similar storm. Courts have construed the flood exclusion in different states. And as I mentioned, the courts will define flood where the policy doesn't have a definition. So in a Fifth Circuit Federal Court of Appeals decision, the court interpreted flood exclusions, which were by and large the same exclusion. The case dealt with Hurricane Katrina damages. It was in Ray Katrina canal breaches litigation. Levees along 3 major canals in New Orleans ruptured and the city was submerged in water. Residential and commercial property owners sought coverage under their insurance policies, and the court said that the body of water overflows its normal boundaries and inundates a normally dry area of land. That event is a flood. So the levee, which was a flood control structure, ruptured, allowing the flood to basically become more widespread. So in that case, it didn't matter that the levee was negligently designed, constructed, or maintained. The focus was on the character of the water, which was floodwaters. On the other hand, you could have a different result in a different state. Like Arkansas, for example, courts have stated that the flood exclusion refers to damages arising from natural causes, not artificial causes, such as burst water mains. Now, the National Flood Insurance Program defines flood as a general and temporary condition, a partial or complete inundation of 2 or more acres of normally dry land area or 2 or more properties, at least one of which is your property, which we'll talk about in a little bit. So, the takeaway here to answer your question is your policy probably excludes flood. If it doesn't define flood, you're going to want to consider how your jurisdiction defines flood to discuss and understand exactly what is going to be excluded when you have water damage. And
Okay,
that
so
also prompts you to make sure you have flood insurance.
Okay, thank you. So to the extent that these property policies typically exclude flood, can you get flood insurance separately, and how does that work?
Yes, generally speaking, flood insurance is going to work similarly to any other type of policy, but it's going to be related to flood. So I mentioned the National Flood Insurance Program, NFIP, NFIP. It's managed by FEMA. Insurance companies that offer flood insurance can be an NFIP-approved insurer. The flood insurance can be added to the homeowner's policy by an endorsement, or it can be its own policy. Under federal law 44 CFR 59.1, there's a definition of flood or flooding for purposes of the NFIP. It states that a flood is a general and temporary condition of partial or complete inundation of normally dry land areas from the overflow of inland or tidal waters, the unusual and rapid accumulation or runoff of surface waters from any source, or mudslides, or the collapse or subsidence of land along the shore of a lake or other body of water as a result of erosion or undermining caused by waves or currents of water, exceeding anticipated cyclical levels, or suddenly caused by an unusually high water level in a natural body of water.
So would my 3-year-old splashing around in the tub qualify?
Not for insurance purposes, but you should definitely tax her on that. So under an NFIP policy, to qualify as a flood, there has to be, as I said, either another property besides the policyholders that gets flooded, or the flood has to cover 2 acres of land on the same property. So I just want to make a point here. Earlier in our discussion, I mentioned that flood is often excluded from a homeowner's policy or a commercial property policy. The policyholder doesn't want the exclusion to apply. So under the homeowner's policy or commercial property policy, they want to argue that whatever caused their damage wasn't a flood. But in the context of flood insurance, the policyholder wants to argue that whatever caused the damage was a flood. So it raises the point that you need to look at your policies and really analyze which one is going to give you the best coverage position, giving consideration to your deductibles, policy limits, sublimits, and things like that. So just because there's water intrusion doesn't mean that you want to automatically jump to the conclusion that it is or isn't a flood. If you have the right coverage, you may need to work with counsel early on to develop a strategic plan to maximize your coverage position. And I just want to take a quick minute and show this image here. Before and after Hurricane Matthew, we mentioned NFIP including erosion in the definition of a flood. This is just an image to show before and after Hurricane Matthew. The storm surge caused erosion, and you can see it. You can see where the water line changed, and now there's a waterway going through, and you can see the damage to the homes in there.
I think, yeah, so jumping in for a sec, I think there's a couple of points that I'd like to just piggyback off of Holly's comments. I mean, so one is, she mentioned briefly before, and to a certain extent throughout all of her comments, this notion of separate perils combining to cause a loss, where an event that happens, damage that happens, is not solely and exclusively caused by some water event. It's usually the water gets into, let's say if we're talking about interior water damage, it gets into that space somehow. It doesn't just manifest on its own. And there's, for the pure insurance and legal nerds out there, and that's not something to aspire to, there's a case that those in South Florida are, South Florida principally, though perhaps all of Florida, are intimately familiar with, and that's the SEBO decision, S-E-B-O, and it's interestingly enough involved a property that's near to our office here in Naples. And Kelly had the great distinction of being involved in a variety of respects that went all the way up to the Florida Supreme Court and talked about a scenario, and I'm going to oversimplify for illustration purposes, talked about a scenario where there was a certain amount of construction workmanship, arguably faulty, that allowed water to enter into a property, and then there was an ensuing internal water damage. And the debate became which of those two things was the cause. And the court looked at that and said, you know, it's important to be aware that there are essentially two types of fact patterns that can exist in this kind of scenario. There's what's referred to as a concurrent cause scenario, where you have two completely independent perils that one doesn't cause the other, but that combine to allow a loss to happen. The other is a sequential loss, where you have a series of interdependent perils that combine, that without each of them don't result, there is no loss. So that might be a scenario where you have, let's say, you know, a fire inside a building that sets off a sprinkler, which soaks a wall, which then turns into mold. And the question is, you know, along that continuum of dependent perils, which item is ultimately the cause? And the court said in this SEBO style scenario, where you have two independent perils, so long as one of them is a covered peril, you get coverage, and that's all that matters. Now, I'm going to put a big asterisk on that because there is language that carriers typically use designed to defeat that result. Remember, we're talking about contract law here. So to a large extent, whatever the courts might say about one particular type of contract, one particular type of policy, the parties are free to contract around that. And oftentimes carriers do respond to litigation that turns out unfavorably to them with revised forms designed to address issues the way they would like to see them addressed. So that's important to be mindful of, but it is a useful framework to think about as you're assessing post-loss a damage that you're looking at that might at least initially appear to be matching up with some excluded terms like flood limitations on a policy, to say, let me just think about this for a second. What actually allowed this water damage event to manifest in the first place? And there may be some other element that's involved that could still be covered, and you may have arguments for coverage. And that really is an important point. We're talking about understanding what arguments are available to you, so that you can make a comprehensive assessment of what your rights and opportunities are for aggressively pursuing a claim if that's warranted. The other thing I'd say is as Holly was talking about flood insurance, because that is provided through the National Flood Insurance Program, oftentimes, the type of information that is disseminated about the product you're purchasing can be somewhat scant. It's important to remember that is, despite the fact that it's not through the typical commercial market, you are purchasing an insurance policy contract. And so as you're trying to acquire information to make sure that you're staying educated about what your contractual rights are, it's appropriate to request that the actual terms and conditions of that insurance you're purchasing.
Thank you, and that's an excellent point, Greg. And also, for more information on the concurrent causation doctrine and the different legal principles that go into that analysis, we do have a webinar series, part of this hurricane webinar series. It's part 2, and it's available on our website at www.sdvlaw.com. Now, Holly, can you touch base a little bit on the issue of flood insurance policy limits for our listeners?
Yes, so under NFIP, the policy limits are going to be $250,000 for any 1 to 4 family residential buildings, plus $100,000 for the contents. That limit goes up to $500,000 for the building in a 5+ residential unit, with $100,000 in content coverage. And for commercial buildings, the maximum is $500,000 for building and contents. For a coastal property owner, that's probably not even going to scratch the surface, and that's where excess policies come in. So that's an important consideration. And like I said, that's going to cover building and contents. That's not going to cover the things that are outside your home. You've got seawalls, docks, boats, potentially, lifts. Those things aren't going to be covered by your standard flood policy. The swimming pool, for example. So you need to look into your policies, and let me just give this example. You've got a property policy that appears to cover these structures, but then you have the flood exclusion. And then you have a flood insurance that covers flood, but doesn't cover these types of features that may be unique to a coastal property. So it may look like there's coverage because you've got one policy that covers the structure and you've got one policy that covers the flood, but in reality, each of those policies excludes the other. So you end up having an exclusion for these types of structures. So that's where you want to look into seawall insurance or dock and boat lift insurance. And let me just point out, there's one case that is out there, at least one, where an insurance agent and planners were, the court denied a summary judgment, but there was potential liability there for misrepresenting the availability of seawall insurance in particular. So as the policyholder, you want to make sure you're asking the right questions, ask about the availability of the insurance, and talk to your agent about that. The standard flood policy is also going to exclude personal property. And with coastal property owners, you may have expensive items in your home, artwork, wine collections, more expensive furnishings. So you may need a personal property coverage to fill in the gaps in that coverage.
Yeah, no, just a minor note. I mean, I think having an insurance advisor that knows the market is worth its weight in gold here, because to a certain extent, the strategies and considerations that we talk about can tend towards the more legal and technical. I mean, they're critical because we're talking about legal instruments, but it doesn't necessarily reflect what the insurance market is willing to bear and what's customary practice in certain areas. So, you know, I think that it really behooves people to have an insurance partner, an agent, a broker, advisor. You know, those are all somewhat distinct roles. You know, that is someone that is familiar with and will engage in an analysis of the type of risk that we're talking about to the level that we're talking about.
Now, it's my understanding, you know, FEMA, we hear, gets really involved when these hurricanes and storms blow through an area. Greg, can you tell us a little bit about the FEMA 50% rule in the context of storm damage and what that means for policyholders?
Sure. So a lot of people, I think, in Florida will probably be familiar with this rule, but FEMA has established a 100-year flood elevation level that applies to structures in special flood hazard areas. And the issue becomes that if a property is damaged and the cost of restoring it would be 50% or more of the market value, then the structure has to be brought up to FEMA compliance codes. And a lot of times this is implemented by local governments. So it's important to not only be familiar, if you're in this scenario post-loss, with FEMA's rules, but also what the local government or municipality requires. The relevance of it for what we do is that it can become an important bellwether or foundation, if you will. No pun intended, if that is technically a pun. Maybe it's a little bit intended. I do like puns. For the valuation of the loss, right? So once we get past the notion of talking about the cause of the loss and how that implicates substantive areas of the policy or policies or not, you know, the second kind of critical issue becomes, how do I measure the cost of repair? Now, a critical thing right off the bat, of course, is that every policy to some degree or another is going to have specific provisions about valuation methodology. Very critical to be familiar with how those work and what the policy says about how you measure the value of the loss. But when it comes to the FEMA 50% rule, can be very relevant in identifying, under most methodologies, whether a loss can be deemed a complete loss, and thus the property owner entitled to complete reconstruction. So if you meet these requirements, it's usually a good indicator that the value of the rebuild, if that's what required, is going to be significant, and that should be an important talking point with the carrier as you present your claim. And I use that last word, present, very intentionally, because I think there is, as part of all of this that I talk with clients about, it's important going into a loss adjustment and dealings with your carriers with a very particular mindset. I think oftentimes clients I'm dealing with who, you know, more or less have had good experience with insurance claims or a good rapport with an adjuster that they're talking to post-loss, tend to fall into a practice of just supplying whatever information they have without really a lot of organizational thought about some of the issues we've talked about before, about what caused the loss or exactly what they expect. And sometimes there can be kind of this inherent, well, I'll just give it to the carrier and they'll tell me what I'm entitled to. You know, for what I'm about to describe, it doesn't necessarily mean you need to always hire a team of forensic policy reconstructionists or claim evaluators, but it is critical to go into a claim presentation knowing it's exactly that. You're presenting your claim. And so to the extent that it's reasonable under individual circumstances, that means you should be thinking about proactively, what is my cause? How does that fit with my policy? What is what do I believe the correct value of my claim is? And how do I present an analysis of that damage that matches up as best as possible with what the policy requires and gives me the best opportunity for the full recovery that I'm entitled to under my policy. That can sometimes be done by the policyholder themselves. Sometimes it requires involving, you know, someone who can do an estimation of the damage loss, and there's a variety of different professionals that fit that bill depending on the nature of the context, whether you're talking about in a commercial setting, whether you're talking in a personal line setting. But it's very important, I think, from the outset to take responsibility for explaining the loss to the carrier as you're presenting it in all critical facets, because you're going to have a much better sense for what to expect on the recovery and a much better understanding of where the potential issues may lie, so that you're not several months into the process and then getting some pushback from the carrier that you didn't anticipate.
That's an excellent point, Greg. And as we talk about presenting the claim and understanding, you know, how you're valuing your claim to get the most out of your policy, I know there's a concept out there called valued policy law that kind of fits in here. Holly, can you maybe explain a little bit about valued policy law and how that would work in this situation?
Sure. So valued policy law, or VPL, generally is going to provide that, like Greg said, in the event of a total loss, the insurer, or when you have a total loss, the insurer has to pay the full limits of the policy, even if the value of the structure is less than the insurance amount. So there's a number of states that have adopted value policy laws. They include Arkansas, California, Florida, Georgia, Kansas, Louisiana, Minnesota, Mississippi, Missouri, Montana, Nebraska, New Hampshire, North Dakota, Ohio, South Carolina, South Dakota, Tennessee, Texas, West Virginia, and Wisconsin. So like any other law, you have different states that adopt it, and they also interpret it differently. So there's typically 3 tests that the courts use to determine what is a total loss, which ultimately is going to be the legal question that gets asked. So first you have the identity test, you have the restoration test, and the constructive total loss test. And it's worth noting some states do combine 2 theories here. So Florida, for example, has adopted the identity test. The rule looks to see whether the building has lost its identity and character as a building and has become so far disintegrated that it cannot possibly be designated as a building, even though some part of it may actually still be standing. Louisiana is another state that has adopted the identity test. Under the restoration test, a structure is a total loss if a reasonably prudent owner would not use the remains of the structure as a basis to restore it to its pre-loss condition. So this also is going to give consideration to the components being worthless or unsatisfactory for the rebuilding. In those types of cases, the courts would deem it a total loss. Kentucky and Delaware are 2 states that have adopted the restoration test. And then you have constructive total loss, which that occurs when the building is only partially destroyed, but because of building laws or regulations in force at the time of the loss, like the 50% rule, the FEMA 50% rule, the structure cannot be restored. So states like Delaware and Florida, despite those 2 states having one using the identity, one using the restoration test, they both have also applied the constructive loss theory to blend with their primary theory of loss, if you will. So, for example, like I said, the FEMA 50% rule could come into play because if that's triggered and now you have to elevate a building or a home up to a new level, even though part of the building may still be standing, the building can't be restored because the entire thing has to be lifted. It's also, worth noting that when a constructive total loss occurs, the policy limits on the loss are void. In other words, the VPL is going to supersede the insurance policy exclusions. On the other hand, just because the law requires the repairs does not make the loss a constructive total loss. The law and ordinance has to actually prevent the repairs. It's not enough to say that the repairs are made more expensive. In one case, for example, there was a partial destruction of a roof, and building permits, the city wouldn't issue building permits unless the entire roof was replaced. The insurance company was held to not be required to pay for the replacement of the undamaged sections of the roof in order to comply with the code regulations.
So with all this in mind, Greg and Holly, I'll pitch this to both of you. What are some things that, coastal property owners can be doing now to get ready in advance before the hurricane or a windstorm strikes?
Well, I think it's going to sound fairly straightforward, but sometimes even the most basic concepts are still the most critical. And that is, get your hands on your policies, right? And for people who are less experienced with having to go through that process, if something doesn't look, you're getting materials from an insurance advisor or agent, and it doesn't look like it's a full copy of the policy, meaning you don't see a robust set of terms and conditions and endorsements, make sure you ask, right? I've had that happen where you ask for basic information, even in a commercial setting with people who deal with insurance stuff all the time. You ask for a copy of the policy and you get 3 or 4 pages and you say, doesn't seem quite right. I would think there would be more to this given everything that, the fantastic Holly just said, and you would be right. And so make sure, ask the questions, make sure you've got a copy of your policy. And it's really important to be familiar with some of the fundamentals. So that means, understanding what the policy says that it covers, as important as anything else, what it doesn't cover, and where some of the nuances and limitations lie when it relates to deductibles and sublimits. Because apart from the dichotomy of is it covered, isn't it covered, the next critical question becomes, if it is covered, how much of it is covered? And you want to know ahead of time if you've got potential buckets of coverage, as we call it, that is sublimited areas that are expressly covered but come with a lower value that the policy will pay out on. And the type of risk, going back to the beginning of our conversation, the type of risk you've defined for yourself as being most concerned with might slot into one of those buckets, and yet you find out you've got a lower overall limit that's available. So it behooves you to be familiar with those details.
And I'll just add to that, a lot of policies are going to have high deductibles for named storms or hurricanes. So Greg was talking about the deductibles. You want to know what they are specifically for things like a named storm or a hurricane. In many states, it's a percentage, or many policies, it's going to be a percentage of the value of the property. And sort of going off of what Greg said, as far as understanding the exclusions in your policy, that's going to help you understand the gaps in your policy. So that's where you can start to identify where you may have a need for either endorsements or additional policies to fill in those gaps for things like that seawall coverage or personal property coverage or an umbrella policy or an excess policy that you think may help in the event of a loss. And one more thing that I want to just add is consider setting aside a loss reserve. If you have a coastal property and you have an NFIP policy that's not going to cover nearly what you would need coverage for in the event of a flood, and you're going to be out of pocket, or you have a high deductible and you're going to have to come out of pocket for that difference, you want to make sure that you have the reserve set aside in order to cover it.
Well, thank you both very much for your time today. I really enjoyed doing this program with you. And for the folks that are watching, I just want to go ahead and put up our contact information here. If you have any questions at all related to this presentation or anything else, insurance coverage related for policyholders, please feel free to contact us. Also, please remember to visit our website at www.sdvlaw.com, where we've got the other presentations in this webinar series, as well as lots of other great content related to policyholder insurance coverage issues. So thank you very much for joining us. We appreciate it.
Thank you.
Thank you.